Hi there. In this video, I'm going to be looking at financial processes through monitoring and controlling cash flow statements. So firstly, what is a cash flow statement? Well, it's essentially a financial statement that shows the movements of cash receipts, so the inflows, and cash payments, the outflows, resulting from transactions over a period of time. Okay, could be a quarter, could be 6 months, could be a financial year. So, a statement of cash flows, okay, or cash flow statement, can show whether a firm can generate a favorable cash flow, so have more inflows than there are outflows, pay its financial commitments as they fall due, have sufficient funds, have enough money for future expansion or to make a change. It shows whether they can then obtain finance from external sources because they've got that favorable cash flow. And it also shows whether or not they can pay drawings to owners or dividends to shareholders as their form of income as well. So, in preparing a cash flow statement, okay, so the activities of a business are generally going to be divided into three categories. There's the operating section, basically, so operating activities. These are the cash inflows and outflows relating to the main activity of the business. So that is the provision of goods and services. So income from sales, so cash and credit, make up the main operating inflow, plus dividends and interest received. The outflows consist of payments to suppliers, employees, and other operating expenses, so insurance, rent, advertising, and so on. There can also be the investing activities category. These are the cash inflows and outflows relating to the purchase and sale of non-current assets and investments, so non-current being greater than 12 months. These assets and investments are then used to generate income for the business. So, for example, selling an old car, buying new plant and equipment, or buying more property. And then we've also got the financing activities section of the cash flow statement. These are the cash inflows and outflows relating to the borrowing activities of the business. So borrowing inflows can relate to equity, so issue of shares or capital contribution from the owner or owners, or debt, loans from financial institutions. So essentially what cash flow statements show is really, in a nutshell, even though there's a lot of categories that seem a bit confusing, in a nutshell, show really what is coming in and what is going out of the business. So I hope this brief video has been informative for you. The next video is going to continue looking at monitoring and controlling, but more specifically deal with income statements. Thank you.